Hey everybody, welcome back to Gold Rush Reporter. Today we're diving deep into what might just be the biggest shock the gold and silver markets have seen in decades. We're talking about a historic meltdown, wiping out roughly $10 trillion across gold and silver in just 24 hours. That's not a typo. The change in silver alone is the largest swing since 1980, and it's happening at a pace that has alarmed every seasoned analyst in the market. Now, if you've been following our channel, you probably saw this coming, or at least knew a major correction was possible, but what we're witnessing today is extraordinary. Silver has dropped nearly 32% from its peak over just 2 days. To put that in perspective, this level of movement hasn't been seen in modern history except in extremely rare events. Before this drop, silver's monthly RSI reached 95, a number that has only been hit twice before in over 60 years, once from 1979 to 1980, and again from 2009 to 2011. That's a clear indicator that the market was stretched and ripe for a correction, though nothing could have prepared traders for the scale and speed of this move. What's crucial to understand is that this is not natural volatility. This is almost certainly a form of market manipulation. We're also seeing a massive divergence between US silver futures and physical silver prices in Shanghai. The Shanghai premium hit $44 an ounce, nearly doubling in 1 day, which suggests that while paper silver is collapsing, physical demand in Asia is exploding. The market is behaving in a way that doesn't align with fundamentals, and that tells us one thing: there are powerful players coordinating moves globally. Banks, sovereign wealth funds, and possibly algorithm-driven trading systems are all interacting in a way that pushes prices down while simultaneously creating profit opportunities for those with scale and access. If you're a long-term stacker, today was likely an opportunity. Personally, I purchased silver at the very bottom, around $74, taking advantage of the pullback. I typically buy about 10 ounces per month, but today I doubled down to 20 ounces, counting premiums. The spot price may show $85, but when you include premiums, my entry cost averaged out to roughly $79 per ounce. This is exactly why patience and scaling in are so important in this market. You cannot chase peaks, and you cannot panic sell during corrections. As we look at these massive swings, you can see the gold to silver ratio exploding, moving above 57 ounces of silver for every ounce of gold. These extremes highlight the imbalance caused by manipulation, not by changes in fundamentals. And yet, while paper silver plummets, physical demand is surging. The Shanghai market isn't fooling around. Prices there are roughly $123 per ounce, creating a nearly $38 arbitrage gap with US silver futures. This gap demonstrates the disconnect between paper markets and real physical metal, which is exactly what long-term investors should focus on. Today's events are a reminder. This market is not a straight line. It's parabolic moves followed by sharp pullbacks. Algorithms and derivatives exaggerate these swings, and when global coordination occurs, be it through banks, sovereign funds, or high-frequency trading, the noise can overwhelm casual traders. But if you understand price discovery, scaling in, and the difference between paper and physical, today's chaos is a buying opportunity. Now let's get into what really made today so extreme. This wasn't just a normal pullback or a healthy correction. There were multiple software glitches across key markets. CME, London Metal Exchange, even HSBC in Hong Kong experienced temporary system shutdowns. These weren't minor inconveniences. They had a direct impact on trading algorithms, which automatically feed off market data. When systems hiccup or stop feeding correctly, these algorithms start executing trades in ways that can exaggerate moves. And today, that created a perfect storm for a historic liquidation event. One of the biggest concerns is that CME didn't trigger their circuit breakers as expected. By rule, when silver drops 10%, trading should pause to prevent mass panic selling. Today, silver went down over 30% in a single session, yet no halt occurred. This lack of intervention allowed automated selling to cascade, pushing prices even lower. You can see how easily weak hands are shaken out when the rules aren't enforced. Combine that with physical demand in Shanghai, which kept climbing, and you've got a perfect example of paper silver collapsing while the real market screams for metal. Rumors are swirling that some of this chaos could be linked to deliberate targeting by large players or even sovereign nations. Could China and other major banks be using algorithmic and derivative trades to pressure COMEX? Maybe. There's evidence that paper silver is being reset, while physical silver continues to command premium prices overseas. This suggests coordinated strategies to shake out smaller traders, creating opportunities for those with scale and insight to buy low. As long-term stackers, this is exactly what we should be watching for: dislocations between paper and physical prices. Now let's talk numbers. US silver futures are down around $85, while Shanghai ended at over $123 per ounce. That's a nearly $38 premium, a staggering gap in a market that's supposed to be integrated. If you're a physical buyer, this gap tells you exactly where the real value lies. And remember, today's volatility wasn't random. Algorithms interact with one another, feeding off price movements, creating domino effects across multiple exchanges. One automated sale triggers another, and the cascade effect multiplies the move exponentially. This is why so many traders panic during these events. They're watching charts, not understanding the mechanics behind the swings. What does this mean for you as a stacker? It means patience and calculated entry matter more than ever. If you buy during panic selling, like I did around $74, you position yourself to benefit not just from the market's recovery, but also from the arbitrage between paper and physical. Scaling in, using smaller purchases over time, reduces risk and maximizes opportunity. This is exactly why long-term stackers have an advantage over short-term speculators, who are often forced out during these extreme down days. Lastly, the systemic impact is bigger than just silver and gold. US government debt, potential shutdowns, and global market uncertainty all play a role. None of these fundamentals changed today, yet prices were hammered. That tells you one thing: the market is being driven by forces outside typical supply and demand. Forces like algorithmic trading, derivative manipulation, and coordinated activity by large institutions. Understanding this separates the informed investor from the panic trader. Today's events were extreme, yes, but they were also expected from a technical standpoint. Parabolic moves tend to have sharp retracements, and this one followed that pattern perfectly. The Fibonacci levels held almost exactly, showing that even in extreme volatility, there's order if you know where to look. The big takeaway: don't chase, don't panic, scale in, and always keep an eye on the difference between paper and physical markets. That's where the real opportunities lie. So now that we understand the glitches and the circuit breaker failures, let's break down exactly how this impacted the market structurally. The CME margin system is designed to make sure traders can cover their positions. But when silver dropped 30% in a single day, many accounts were forced to liquidate. This isn't speculative, it's mechanical. Margin calls hit, positions get auto-closed, and that triggers even more selling. Essentially, the system amplifies volatility during extreme moves. The irony? This is the same system that's supposed to stabilize markets. Today, it did the exact opposite. And here's the kicker: algorithms amplify everything. They don't think, they execute rules. When one algorithm sees a drop, it triggers sell orders, which another algorithm sees and triggers more sells, creating a cascading effect. On normal days, this is contained, but when combined with technical glitches and circuit breaker failures, the result is catastrophic. That's why silver experienced a $44 swing in just hours, from over $118 to $74. As a long-term stacker, it's tempting to panic, but this is where strategy matters. Understanding the mechanics allows you to see buying opportunities that most traders simply miss. Now let's talk physical versus paper silver. Paper silver, represented by futures and ETFs, crashed dramatically, but physical silver in Shanghai skyrocketed in premiums, reaching over $123 per ounce. And that's nearly a 50% premium over US spot prices. What does that tell us? It tells us that global demand for real metal is soaring, even as derivatives markets are being manipulated. Anyone focusing only on COMEX prices misses the bigger picture. Arbitrage opportunities are enormous for those who can navigate physical markets. For example, buying physical silver during US lows and holding for delivery or export creates immediate upside when markets normalize. So how does this all tie together? Margin calls force paper liquidation. Algorithmic trading magnifies it, and physical markets react differently. The result: huge disconnect between paper and real-world value. This is exactly why savvy investors buy physical over paper, especially during volatility spikes. Futures might crash, but the metal itself doesn't disappear. In fact, the more fear in the paper market, the higher the value of real silver. This is a critical lesson for anyone in the precious metals space. Never confuse paper pricing with physical value. Another factor is the Fibonacci levels. Even in today's chaos, the 0.618 retracement held almost perfectly, proving that technical structure still applies. Parabolic moves tend to snap back, and today was no exception. The rapid drop aligned with prior swing lows, which means the market isn't broken, it's functioning within its natural volatility range, amplified by technology and structural quirks. Understanding these patterns helps you scale in strategically rather than react emotionally. Finally, let's address the human element. Sovereign funds, banks, and large institutions participate in these markets with the goal of maximizing long-term profit. Small investors, or mom-and-pop traders, often get caught in the frenzy without realizing that the volatility isn't random. It's orchestrated to shake out weak hands and create liquidity for bigger players. By recognizing these patterns and understanding market mechanics, you can turn what appears as chaos into opportunity. Today's pullback wasn't a signal to exit. It was a chance to accumulate at historically discounted prices. Now, moving deeper, one of the most critical points from today's meltdown is the idea of a CME silver reset. Many rumors are swirling that the software glitches, margin calls, and algorithmic triggers weren't just accidental. They may have facilitated a sort of forced reset in the paper silver market. If you recall yesterday, CME margins on silver were unusually high, forcing traders out of positions. When positions auto-liquidated, futures contracts expired or rolled over, which effectively reset the derivative exposure on COMEX. This is exactly why the paper price can swing so violently, without necessarily reflecting the underlying physical demand. The lesson: paper markets are not the metal, they're just a trading instrument. Now add in the algorithmic angle. Algorithms dominate modern commodity trading. These programs are designed to execute trades based on preset criteria, and when multiple programs interact, they can create a self-reinforcing chain of selling or buying. In today's crash, algorithms likely triggered off each other, compounding the 30% drop in silver. Combine this with the technical glitches at CME, London Metal Exchange, and HSBC Hong Kong, and you have a perfect storm. It's easy for small traders to panic, but long-term stackers see this as an accumulation opportunity. Real silver doesn't vanish, it just becomes temporarily undervalued in paper markets. Here's where the physical versus paper arbitrage comes back into play. As US futures tanked, Shanghai premiums exploded. Physical silver in China was trading nearly $40 above US spot prices, highlighting the disconnect between global physical demand and paper pricing. Arbitrage opportunities arise because if you can access physical metal and hold it through this volatility, you benefit from global imbalances. This is also why stacking physical silver is the safest long-term strategy. Futures contracts can be manipulated, options expire, algorithms crash, but physical silver always has intrinsic value. Next, let's discuss long-term stacking strategy. The key principle is scaling in, not timing perfectly. Today, some traders might have panicked at $74, while others saw it as a chance to buy double or triple their usual allocation. By maintaining consistent purchases over time, using dollar-cost averaging, stackers turn extreme volatility into an advantage. The biggest gains come to those who buy during fear and hold through market chaos. Remember, the silver we bought today might appear volatile on charts, but it represents tangible value that cannot be erased by algorithms or margin calls. Technically speaking, even with today's flash crash, the Fibonacci levels held. The 0.618 retracement aligns with prior swing lows, showing that the market still respects technical structure despite all the noise. Parabolic moves often see sharp corrections, and the recent drop is simply part of that natural volatility. This means that even dramatic moves like today's can be anticipated using structured analysis rather than emotion. Traders who understand these levels can position themselves for long-term gains rather than short-term panic. Finally, the human and institutional factor cannot be ignored. Big money players, sovereign funds, and banks often manipulate the paper market to shake out weak hands, create liquidity, and maintain pricing control. Today's chaos is a reminder. Small traders are not competing on the same level, but this doesn't disadvantage long-term stackers. On the contrary, understanding how these entities operate allows everyday investors to capitalize on discounted prices. While the paper market experiences a frenzy, physical silver continues to reflect true global demand. Looking at the bigger picture, today's silver and gold crash isn't just about US futures or CME glitches. It reflects global market dynamics. The paper price may have tanked 30%, but physical demand tells a very different story. In China, for example, the Shanghai premium soared nearly $40 above US spot, showing that global buyers are still aggressively acquiring metal. This divergence is crucial. While the West experiences paper-based volatility, the East continues to accumulate physical silver and gold at unprecedented rates. Over the next few months, stackers need to understand this East versus West dynamic. As sovereign funds, banks, and large institutions manipulate prices in COMEX and London, China and other Eastern buyers act as a counterbalance. They are not reacting to daily paper swings. They are focused on long-term accumulation. This creates a strategic opportunity. While Western paper markets fluctuate wildly, physical metals quietly gain real value. For stackers, the lesson is clear. Prioritize physical holdings and don't let daily charts dictate your decisions. Another critical factor is debt and currency pressures worldwide. US national debt, unfunded liabilities, and global currency expansion continue to rise. These macro factors inherently support gold and silver over the long term. Today's crash does not change these fundamentals. It's temporary noise, a shakeout designed to trigger algorithms, force short-term liquidations, and create buying opportunities for those with patience and knowledge. Stackers who understand these macro forces can use events like today's to add strategically to their holdings without fear. Technically, silver's Fibonacci levels held perfectly, reinforcing that even extreme volatility follows predictable patterns. Parabolic moves, sharp corrections, and overshoots are normal in these markets, especially when algorithms and institutional players are involved. This knowledge allows long-term investors to identify entry points with confidence. Scaling in across dips ensures that your average cost remains favorable while minimizing emotional risk. For instance, buying 20 ounces today at $79 as I did may look aggressive on paper, but in the context of global physical supply and long-term trends, it's an optimal strategy. Looking ahead 3-6 months, expect continued volatility, but also increasing divergence between paper and physical markets. COMEX may continue to experience technical issues, circuit breaker failures, or algorithm-driven spikes, but physical markets in China, India, and other major buyers will continue accumulating. Stackers should remain disciplined, continue dollar cost averaging, buy on dips, and always prioritize tangible metal over derivatives. Remember, the ultimate goal is physical ownership, not chasing paper profit. Finally, today's events serve as a wake-up call. Not all market participants are honest, and many social media voices are anonymous or algorithm-driven. Avoid hype and focus on verified data, historical patterns, and fundamental analysis. When you combine this with disciplined stacking, you protect yourself from manipulation while positioning for maximum long-term gains. Gold and silver are not just commodities. They are insurance against systemic risk, currency debasement, and global financial instability. In conclusion, today's crash reinforces three main principles: the importance of physical accumulation, the reality of global manipulation in paper markets, and the need for long-term strategy with disciplined scaling in. For stackers who understand this, volatility is an opportunity, not a threat. By focusing on fundamentals, monitoring global demand, and acting strategically, you can turn events like today's meltdown into a powerful long-term advantage. So keep stacking, Stay informed, ignore the hype, and use market volatility to your benefit. Gold and silver will always have intrinsic value, even when paper markets attempt to deceive, manipulate, or panic traders.